studying your last two. I swim med when I turned in. The staring down to mute. And can learn a pole that some kid died.
We've now completed Schedule 1 and calculated the corporation's taxable income for Barnes Dentistry. The taxable income is $410,500. This is a major milestone in the tax preparation process. However, an important question still remains. How do we determine the corporation's actual tax bill? Many new tax preparers assume that once taxable income has been calculated, the tax payable is obvious. But that's not how corporate taxation works. Taxable income is only the starting point. The actual corporate tax payable requires several additional calculations. Let's begin on the left side of the slide. Schedule 1 has produced taxable income of $410,500. This number is the foundation of the corporate tax calculation. Everything that follows will be built from this amount. Think of taxable income as the raw material entering a tax calculation factory. Now look at the center of the slide. Notice the large calculation pipeline. This pipeline illustrates the journey from taxable income to corporate tax payable. The first stage is the federal tax calculation. At this point, the corporation's taxable income is subjected to the applicable corporate tax rules and rates. This produces an initial tax amount. However, that is still not the final answer. Next, we move to special corporate tax rules. This is where several important concepts enter the calculation. The small business deduction may reduce tax payable. Investment income rules may create additional tax consequences. Part 4 tax may apply because of dividends received from other corporations. These adjustments are unique to corporate taxation and can significantly change the final result. After those rules have been applied, we move to credits and reductions. Certain deductions, credits, and adjustments may reduce the corporation's overall tax burden. Only after all of these steps have been completed do we arrive at corporate tax payable. This is the amount ultimately owed to the Canada Revenue Agency. Now look at the right side of the slide. Notice that the final tax bill is still shown as a question mark. That's because we haven't yet completed the tax calculation process. We know the taxable income, but we don't yet know the final tax payable. The purpose of the next several calculations is to bridge that gap. One of the most important concepts on this slide appears in the panel labeled Important Concept. Taxable income is not the same as tax payable. Taxable income tells us the amount of income subject to tax. Tax payable tells us the actual amount of tax that must be paid. Those are two very different numbers. A corporation with the same taxable income can have a very different tax payable depending on factors such as the small business deduction, investment income, dividend income, refundable taxes, and other tax attributes. That's why corporate tax calculations require much more than simply applying a single tax rate. Notice the message at the bottom of the slide. Taxable income is only the beginning of the corporate tax calculation. That statement captures the entire purpose of this section. Everything we've learned so far has helped us calculate taxable income. Now we're shifting our focus toward calculating tax payable. The goal is to transform taxable income into the corporation's actual tax bill. The key takeaway from this slide is simple. Schedule 1 gave us taxable income of $410,500. But that is not the corporation's final tax obligation. To determine corporate tax payable, we must now apply tax rates, special corporate tax rules, deductions, credits, and refundable tax provisions. Only then can we determine the corporation's true tax liability and complete the T2 return. In the next step, we'll break down each component of the corporate tax calculation and see how every schedule contributes to the final tax bill. Now that we've established that taxable income is only the starting point, let's break down the actual corporate tax calculation. One of the biggest challenges for new tax preparers is understanding that corporate tax payable is not determined by a single formula or a single tax rate. Instead, multiple components work together to create the final tax bill. This slide introduces the major building blocks of that calculation. Let's begin with the formula shown at the top of the slide. We start with federal tax. We add any applicable special taxes, such as Part 4 tax and certain investment income taxes. We subtract available reductions, including the small business deduction and other credits. The result is corporate tax payable. Each component has its own rules, calculations, and supporting schedules. Let's look at each one individually. The first component is federal tax. Federal tax begins with taxable income. The government applies corporate tax rates to determine the corporation's base federal tax liability. Think of this as the foundation of the tax calculation. Without taxable income, there is no federal tax calculation. That's why Schedule 1 is so important. It provides the taxable income figure that drives everything else. The second component is the small business deduction, often called the SBD. This is one of the most valuable tax benefits available to many Canadian-controlled private corporations. The small business deduction reduces tax on qualifying active business income. Instead of paying the higher general corporate tax rate, eligible income receives a lower effective tax rate. As a result, the small business deduction reduces the corporation's tax payable. You can think of it as a tax shield protecting a portion of active business income. Next, we have Part 4 tax. We've already encountered this concept when studying Schedule 3. Part 4 tax applies when a corporation receives taxable dividends from other corporations. In the Barnes Dentistry case, dividend income generated Part 4 tax through Schedule 3. Although this tax is generally refundable in the future, it still forms part of the corporation's current year tax calculation. This is why dividend income has such a unique reporting path. The fourth component is investment income tax. Investment income often receives different tax treatment than active business income. Interest income, rental income, and taxable capital gains may be subject to special corporate tax rules. These calculations are heavily influenced by the information gathered in Schedule 7. The goal of these rules is to limit the tax advantages associated with earning passive investment income inside a corporation. Now let's look at the panel on the right side of the slide. Notice how each schedule contributes information to the final tax calculation. Schedule 1 provides taxable income. Schedule 3 provides dividend information and Part 4 tax calculations. Schedule 6 contributes capital gain information. Schedule 7 provides investment income details. Together, these schedules create the data needed to determine corporate tax payable. This highlights an important lesson. No schedule operates in isolation. Each schedule performs a specific job, and the final tax calculation combines the results from all of them. Notice the message at the bottom of the slide. Corporate tax payable is determined by multiple components, not just taxable income. This is one of the most important concepts in corporate taxation. Two corporations with identical taxable income may have very different tax payable amounts depending on their dividend income, investment income, eligibility for the small business deduction, and other tax attributes. The flow diagram at the bottom summarizes the process perfectly. Taxable income creates the foundation. Tax rates create the initial tax. The small business deduction reduces tax. Part 4 tax may increase tax. Investment income rules may create additional tax consequences. And the final result is corporate tax payable. The key takeaway from this slide is simple. Corporate tax payable is the combined result of several interacting tax rules. Understanding each component individually makes it much easier to understand the final tax calculation. In the next step, we'll bring everything together and perform the complete Barnes Dentistry corporate tax payable reconciliation from start to finish. We've now reached the final stage of the corporate tax calculation process. Up to this point, we've analyzed the corporation's income, reported dividends, calculated capital gains, prepared Schedule 7, completed Schedule 1, and determined taxable income. Now it's time to bring everything together and calculate the corporation's actual tax payable. Let's begin with the starting point at the top of the slide. From Schedule 1, Barnes Dentistry has taxable income of $410,500. This figure becomes the foundation for all remaining tax calculations. Every corporate tax calculation begins with taxable income. The next step is calculating the corporation's base federal tax. Using the applicable corporate tax rates, taxable income of $410,500 generates federal tax before reductions of $108,283. Think of this as the preliminary tax amount before applying any special corporate tax rules. Now we move to one of the most important tax reductions available to Canadian-controlled private corporations, the Small Business Deduction. The Small Business Deduction reduces tax on qualifying active business income. In this example, the deduction reduces tax by $45,155. This is a significant tax benefit and one of the reasons many business owners choose to operate through a corporation. Next, we incorporate Part 4 tax. Remember that earlier in the case study, Barnes Dentistry received taxable dividends from another corporation. Those dividends were reported in Schedule 3 and generated Part 4 tax of $8,395. Although Part 4 tax may eventually be refundable, it still forms part of the corporation's current year tax calculation. Now let's add the impact of investment income. Schedule 7 identified interest income, rental income, and taxable capital gains. Because passive investment income is subject to special corporate tax rules, an additional investment income tax amount is generated. In this example, the investment income tax is $3,876. At this point, all major components of the tax calculation have been assembled. Now look at the tax payable reconciliation section in the center of the slide. We begin with federal tax before reductions of $108,283. We add Part 4 tax of $8,395. We add investment income tax of $3,876. Then we subtract the small business deduction of $45,155. After applying all of these adjustments, the corporation's tax payable is $75,399. This is the amount shown in the large green box. This represents the corporation's tax liability before considering any future refundable tax balances or other year-end adjustments. Now look at the information flow panel on the right side. Notice how each schedule contributed something important. Schedule 1 provided taxable income. Schedule 3 generated Part 4 tax. Schedule 7 provided investment income information. And all of those calculations were combined to determine tax payable. This is exactly why corporate tax preparation is often described as a puzzle. Each schedule solves a specific piece of the problem. Only when all pieces are assembled can the final tax liability be calculated. The tax preparer mental model shown on the right summarizes the entire process. Start with taxable income. Apply federal tax rates. Add special taxes, such as Part 4 tax and investment income tax. Subtract available reductions, such as the small business deduction, and arrive at corporate tax payable. Finally, Look at the timeline along the bottom of the slide. This represents the complete journey we've followed throughout the Barnes Dentistry case study. Financial statements. Schedule 3. Schedule 6. Schedule 7. Schedule 1. Taxable income. Tax calculation. Tax payable. And finally, the completed T2 return. The key takeaway from this slide is simple. Corporate tax payable is not produced by a single schedule. It is the result of every schedule working together. For Barnes Dentistry, taxable income was only the beginning. The final tax payable emerged after applying federal tax rules, investment income tax rules, dividend tax rules, and small business deduction benefits. This is the point where all of the work performed throughout the T2 preparation process comes together and produces the corporation's final tax liability. And with that, we've completed the full journey from accounting income to corporate tax payable.